Ladies and gentlemen, thank you very much for coming tonight. As Benjamin has just shown us, there are many, many different ways of making money in the market, but I can assure you that there are even more ways of losing money in the market. So our challenge is to find the method that suits us most effectively. So what Benjamin does is not something that I would dream to try and tackle. But then again, what I do is probably something that Benjamin wouldn't dream to tackle. So what I want to do tonight, in 20 minutes, is have a look at the big issues that help define the markets and where we are. Some people have called it an orange swan event, and that's probably a reasonably accurate description. I want to look at the strategic methods that I use for analysing markets that help me to determine where I want to be positioned. They will determine the tactics that I will use in particular market situations. And then I want to look at a couple of commodity markets on a 3 to 12 month basis and explain how I reach the conclusions that I reach. So strategically, the first thing we're looking at, let's call it tariff dreams. President Trump seems to be convinced that the imposition of tariffs is going to bring nothing but benefits to the United States. But we think that markets are heading for a fall and a reversal. So that means that what we're looking for is patterns of trend reversal. And there are several reliable patterns. The most reliable all is a head and shoulder pattern. And we saw that at the beginning of 2008. We've seen it several times since. These are patterns with a high probability of developing as expected. We need to remember that the value of materials made by US companies and sold in China, not in the US, but made, manufactured and sold in China, is about $250 billion last year, which is about double the $130 billion of products from China that were imported into America. That's going to show up in the first half of 2019. So from a strategic perspective, we think that markets are likely to begin to roll over. So we need to be alert for the sorts of patterns that will tell us that that's happening. Because the reality is that Trump is pulling apart the World Trade Order, an order that's been established for 50 plus years since the end of the Second World War. It doesn't necessarily mean a deliberate attack, the ones that we see in the newspapers. Some of it is what we might call white-handing, undermining like termites. So for instance, when we look at World Trade Organization dispute resolution processes, it requires 3 arbitrary judges to be able to handle the arbitration procedures. Currently, Trump has refused to endorse nominations for judges who recently retired. 2 other judges will retire early in 2019. 3 appellate judges are required for any WTO decision. There will not be 3 appellate judges available to make a decision. So Trump doesn't actually have to attack anything simply by refusing to endorse a variety of processes and regulations. This leads to a freezing up of the system. There's no institutional mechanism remaining. So the rational response is self-interest, and that leads to a collapse of the existing trade order or the replacement of the existing trade order. And if we look across the harbour to Shenzhen and we look across to Belt and Road Initiative, then we've got, I won't say a monster, but we have a mechanism that sits in place that has the potential to add to or replace or supplement WTO. It's something we need to take into account when we're considering the way the markets are likely to develop and the volatility is likely to come into those markets in the next 12 months. How do we position ourselves strategically in that environment? And that interruption in trade, of course, leads to a commodity demand shift. If we impose tariffs on China, if we close down or slow down the Chinese economy, that has impacts on iron ore, it has impact on gold, it has impact on soybeans, it impacts across a whole range of commodity processes. How do we position ourselves to take advantage of those changes? Are we looking at a bearish or a bullish situation? Is there an alternative to the current market structures? I do a lot of work with the Australian government at a variety of state and federal levels around a range of trade issues. The impact of One Belt, One Road, the development of alternative trade environments and trade procedures provide a tremendous range of opportunities within the commodity space. It cannot be assumed that Trump's victory in tariffs will automatically result in the destruction or the contraction of the Chinese economy. We think that Belt and Road and One Belt, One Road initiatives across Eurasia and into the ASEAN region are potentially likely to supplement the demand that will be lost from the US perspectives. So they'll be trading on our own terms, on BRI terms, through alternative market structures. And one of the challenges is to understand how that's going to be done. It will be to understand whether Shanghai becomes a price maker rather than a price taker. What role will Darwin Exchange play in setting prices for soybean as distinct from taking prices for soybean? So strategically, we're looking for some significant changes taking place within the trade environment, which will feed through to the commodity environment and the way the futures are going to be handled going forward in 2019. So how do we analyse those situations? I have a couple of particular methods that I use on a regular basis for, first of all, the strategic analysis. So what I'm looking for in particular, the method I use is a Guppy multiple moving average. Can I ask who is relatively familiar with GMMA? Please indicate, otherwise I will bore you to tears. Okay, I'm only going to bore one person to tears. GMMA looks deceptively simple, but what it does is it captures the fractional repetition of behaviour in the markets. It's combined of two groups of moving averages. The short-term group gives us an idea of how traders are thinking. The longer-term group gives us an idea of how investors are thinking. There are three key relationships. When each group compresses, it tells us there's an agreement about price and value. That doesn't last very long in the market. Expansion tells us that there is disagreement about price and value. When you get compression with both the long-term group and the short-term group, that increases the probability that the trend will change direction. When you have both investors and traders agreeing about price and value, that is simply not going to last in the market. So it becomes a key point where there is a change in the balance of probability, in this case, from a downtrend to an uptrend. Because it's capturing the fractional repetition of behaviour across multiple timeframes, we find it gives us a very reliable guide both to trend change, strength of trend, and when prices pull back, whether that's likely to develop into a trend change or becomes a buying opportunity for a continuation of the trend. That's my technical analysis. We get more complicated than that, but that forms the basis of my strategic analysis of where prices are likely to go, whether trends are likely to continue or whether they are hovering for a trend change. But at heart, I'm a chartist. And the difference between a chartist and a technical analysis or technical analyst is quite important. A chart simply uses the price activity seen on a price chart, analyses the structures and the behaviours of that, and uses that to set high probability targets. In this particular example, we have a trading band. Yeah, simple stuff. You draw a line here and you draw a line there. Where you put your lines and how you place them is particularly important. These are on both support levels and on resistance levels. One of the useful things, it's really simple, is you simply measure the height of the trading band, project that upwards to give you a trading target, project it downwards to give you a trading target. Does it work? Consistently, yes. And there are some markets that are much more compatible to this style of analysis than others. But when you combine that with GMMA analysis, when you're understanding how the trend is behaving, how well supported it is, how durable it's likely to be, how resilient it's likely to be, then the application of chart-based analysis gives you high probability targets that you can aim for in setting up individual trades. Now, we use continuous futures contracts, continuous futures charts to be able to do the strategic analysis. We will then come back and drill down to make particular trade analysis. So my argument is that the S&P, Nasdaq and Dow are likely to develop significant trend change behaviour in the first half of 2019. If we look at S&P, and we can trade those through CME S&P futures, then what are we looking for? The first thing we need to look at in this particular chart is the strength of the underlying trend. The separation in the long-term group of moving averages, that's the red lines on this chart, had been consistently well separated. When the market pulled back, that acted as a shock absorber. Think of a Tata airbag, except it's more reliable than a Tata airbag. As it came back, investors came into the market as buyers. They absorbed that sell-off. So entering back into that pullback on the long side was a high probability trade for a continuation of the uptrend. There is a small trading band sitting there. It's not particularly good. It sets us an upside target of around 3,000 at this point in time, but that's moving forward. What we need to look at and be aware of is the end of trend patterns that are likely to develop. And the end of trend patterns we see on the price chart will be supported by the behaviour of the multiple moving averages. And we will begin to see, first of all, a closing of the gap between the long-term group, the blue lines, and the short-term group. Sorry, the long-term group, the red lines, the short-term group, the blue lines, as has happened a little bit earlier on, but then a penetration and a compression in the long-term group. The compression tells us that investors are no longer as active as buyers, that they are holding their positions or turning into sellers. When we look at the price chart, the patterns we're likely to see are, first of all, a head and shoulders pattern. This is something that develops over 3 to 4 months, not 2 or 3 days, not 3 or 4 weeks. It generally is a 3 to 4 month pattern. It has a high reliability as an early warning signal of significant trend reversal, and that is confirmed with compression in the long-term group of averages and the way that the short-term group of averages also compress and move below that long-term group. It tells us that traders are clustered on the short side rather than the long side. The other pattern that occurs at the end of markets is a rounding top, and again, the rounding top tends to be a 3 to 4 month pattern. It just simply means that the top behaviour of the candles in that period are most easily defined with a curved line rather than a series of straight lines. They are leading indicators of market changes and market collapses. When we look at Shanghai market, of course, is a little bit more desperate. What we're looking for there is the reverse of end of trend patterns. We're looking for a consolidation to develop, for the market to stop its decline. Currently, there is some consolidation around 2,600. However, if you look at those groups of moving averages, the long-term group, the red lines, are well separated. It's telling us that every time the market rallies, as it has in the last 2 days, that investors are selling down into that market. There is no indication that that selling down pressure is beginning to weaken. So what we're looking for is potential consolidation down around 2,300. Now, the fundamental analysts will tell you that there's some good value sitting in Chinese stocks at current levels, and it will be even better when it's around 2,300. But from a technical perspective, we're looking for signs of consolidation around that 2,300 level and then a fairly rapid rally rebound. That's a characteristic of Shanghai market. And each market has its own particular characteristics. Shanghai tends to create pivot point lows that are quite violent and quite dramatic, and wonderful trading opportunities as a result. That market is in the process of readjusting both to tariff behaviour and to the development and expansion of new markets. So it's going to take some time to work through. We're looking again probably towards post-Golden Week, post-October, November, before we start to see a fall down to 2,300, consolidation at that level, and then a bounce away. Of course, on the bounce up, 2,600 becomes a major resistance level, followed by the 3,000 level. If we're looking at oil, WTI, again, for a strategic analysis, we're using a weekly chart. It helps us to decide how we're going to position ourselves. So, for instance, here, the underlying trend reversal is very, very strong. The red group, the long-term group of moving averages, are widely separated. That tells us that investors come into the market as buyers every time price retreats. They see the price retreat as a buying opportunity because they are confident that the market is likely to continue in its current and existing trend. There is one key difference in this particular market. You can see the underlying trend line there. It's a simple straight trend line. We had dropped below that. Prior to that drop below, that trend line was acting as a support level. Now, that trend line acts as a resistance level. So it means that the recovery from 66 as we move towards 76 is hindered by the trend line acting as a resistance level. A break above that trend line and a return to its behaviour as a support level is particularly bullish. But across WTI tends to move in well-defined trading bands. They're between $10 and $11 wide. So it moves from 66 to 76, 76 to 86, 86 to 96. When it gets to 96, it gets all nervous. and we hover around the 100 because that's psychologically important for a whole lot of fundamental analysts. Once we move above 100, then it tends to be 110, 120, 130, 140. Remember those good days? They were good if you're trading on the long side. So the behaviour of this market is both a strong trending behaviour, as shown by the GMMA, but it's defined by the way that it moves through a series of trading bands. Why does it move in trading bands? I have no idea. I don't need to know. All I need to be aware of is that this is consistent behaviour in WTI, and that once we get a solid break above 76, the next upside target is most likely to be 76, and I can trade that $10 move. And with the futures market, with the leverage that's available, that gives me significant advantages in the way that I trade that particular product and that particular commodity. So we use the strategic analysis from the weekly chart, which is analysed on a technical basis, then transfer that to the way that we take positions on a tactical basis, on either a weekly or an intraday basis, trading into those markets. If technical analysis is correct, if your application of technical analysis is correct, then the support and resistance levels that you see on a weekly chart will also be confirmed on a daily chart, and they will be confirmed on an intraday chart as well. These become major reactive levels. If your placement of support and resistance levels on a weekly chart are not supported, not validated by a daily chart or by the intraday chart, then your placement of those support levels, your identification of those support levels, is incorrect. It's not a matter of you just drawing lines at random. The market will validate the positioning of those lines. Look at gold. Gold, supposedly, the risk environment. The current environment, it's not laying off risk. Risk is off if you're looking at the gold chart. The consolidation that's taking place is not enough to halt the trend. It's unlikely in this relationship to be the beginning of a trend reversal. This suggests that gold still has further to fall towards 1130 as a target level. But the rebound, as is shown historically, is likely to be fairly rapid. How do we work it out? Again, we're looking at the relationship between the traders and investors. Now, obviously, with a small group of moving averages, we can't say that these are traders, but we can use that as a proxy for the way that traders are thinking. Because in the chart and in the price activity, we're capturing all of the behaviour, all of the thinking, all of the positioning action that's taken place of all the active participants in the market. They're telling me what they think and what they're prepared to back with money. Anyone can have an opinion, and I'm quite happy to listen to the opinions, but until you back your opinion with money, your opinion is literally worthless. So the behaviour that's revealed through price activity forms the basis of how I understand the thinking of other traders and participants in the market. And I can choose to trade along with them or to trade against them. In this particular instance with gold, trading a rally in the context of this well-established downtrend, I won't say it's a loser's game, but it's certainly short-term positions rather than long-term positions. The short-term group of moving averages is well separated. It's telling us that the traders are looking purely at short positions. They will sell into the rallies for a continuation of the downtrend. We're looking for a move towards 1130. Once it gets there, then we're looking for consolidation behaviour, for those patterns that will tell us that there's a high probability of a trend reversal. Sometimes you will see an inverted head and shoulder pattern. That tends to apply to indexes rather than specifically to commodities. What you tend to see in a commodity trade is that the reversal will be much more rapid, the equivalent of a V-shaped recovery. It will come off a pivot point low. So we're not seeing evidence of that at current levels, so we're waiting for a continuation of this downtrend towards 1130, and then we are sitting ready to take advantage of any fast rally that develops off there, because that has the potential to be the beginning of a sustainable trend change. We're running a little short on time, so we'll just on US dollar and finish on that. US dollar continued strength. Notice how it trades in trading bands consistently. So our next upside target is the next highest trading band, which is at 97, followed by 99. We need to strap ourselves in to some pretty turbulent times. We have no control over what happens. Turbulence continues, but the laws of market behaviour remain unchanged. Trade bands and understanding the way investors are thinking will provide a reliable guide to price targets. Futures remain the primary way in which we can mitigate this risk. Moving forward, we're watching China markets to become price makers, not price takers, as Belt and Road Initiative accelerates. Thank you very much.